Good morning. It's great to be with you again. And today is the day, 5th of November, the US presidential elections. The thing we've been waiting for months and months and months. Everybody's talking about it. It's all over the news. The ballots close tonight, I think, at Alaska at midnight their time. And it'll be a few days before we get results, but a lot hinges on the elections today. Will it be Trump? Will it be Harris? Will it be a split Congress? Will it be a red sweep? Will it be a blue sweep? And if Harris does win, will the elections be contested? So lots of outcomes and unfortunately, some big impacts on South Africa and our portfolios and our daily lives. And I'll talk more about that later. We also today have Anrich, our head of fixed income, who'll be taking us through the Income Maximiser Fund, which has had phenomenal performance. So please stay tuned for that insight. It's a great fund. But let's start with a look back at the month of October. As you can see, gold, the clear winner, up 7% in rands, and that's been driven by continual demand from emerging market central banks. China, Russia in particular, India as well, all gobbling up the gold. And who's selling? It's private sector, the ETF holders. They're selling as prices get to dizzy levels. Certainly with gold at current prices, at nearly 3 times the price of platinum, it is quite hard to see how much further it can go, but it can go higher. Emerging market central banks can continue to buy. For those of you looking for a value hard currency option, platinum is actually starting to show signs of life, and it's a third of the price of gold. So that's something that is looking at least less expensive. What else? We had a great month from the FANG stocks. Google came out with some great results. Taiwan semiconductor manufacturing out in Taiwan, but showing some very strong demand for chips, and that drove up the FANG stocks as well on the back of all-round strong demand, despite some disappointing numbers from Apple and Meta that held back some of the stocks. But overall, FANG stocks having a decent month, up 4.5% in rand terms. That drove up US equities, which also had a decent month, thanks to the technology stocks. What else? The UK had a tough month. The UK, they're down 3% in rand terms after a really tough budget. Huge tax increases in the UK. It made our budget look relatively fantastic. So there's always a silver lining to something like that. But it's also important to remember, and this was a question that came through, so I'm going to just answer it now, that the FTSE 100, which is what the Sygnia Income UK index tracks, is not really linked to the UK economy. You've got to go much further down, FTSE 200, FTSE 300, get to mid and small caps where you get exposure to the UK economy. FTSE 100 is dominated by global behemoths that get revenue from around the world. In particular, there's quite a strong share of oil petro companies in the FTSE 100. So depending on your oil outlook, you can get involved in that sector. But the FTSE 100 not directly impacted by what's happening in the UK with the budget and the taxes. Just a small extent, but it's quite protected compared to small mid caps. Just like South Africa, with our top 40 being very much driven by offshore revenues, and you've got to go down to the small and mid caps to get South African Inc exposure, which we've seen for a while. What else? Healthcare also having a tough month, down 2.5%. That was on the back of some announcements from Eli Lilly and Novo Nordisk, who both had setbacks to their major drug names in terms of the semaglutides. But looking into the details, it seems to be mostly driven by demand issues, some supply issues, and not by demand. Demand for those weight loss drugs still looking very strong, but we'll be watching those closely to see exactly what happens. And then lastly, the rand losing ground to the dollar. So dollar cash in rand terms up 2%, and that was on the back of some strong numbers out of the US. So some interesting moves for the month of October. So you can see some winners, some losers, markets all over the place, really. So how did this impact our funds? We're looking at the top funds for the month. You can see it's dominated by US only US companies in the top 5. In first and second place, we have Fang.ai, the unit trust, and the ETF. In third and fourth place, we have the Fourth Industrial Revolution Fund, the unit trust, and the actively managed ETF. And in fifth place, we have the US ETF. And a similar story over 12 months, you've got listed property hanging in there at number 2, with still a fantastic return of 49%, but otherwise dominated by US stocks, Fang in first and third, Fourth Industrial Revolution unit trust making a fantastic comeback into fourth place over 12 months, and then the US ETF in fifth place. And according to the Korean report, which came out a few days ago, for the 1 year to the end of October, in the global equity category, Fang is number 1 and Fourth Industrial Revolution Fund is number 2. So a gold and a silver for those 2 funds over 1 year. So fantastic news on those 2 portfolios. Very, very nice to see. Okay, so let's move on to markets. It's been a very, very, very busy time in markets. Not only has everyone been completely absorbed by the US elections, but more importantly, some major changes coming out of China. I did speak about it last month, and we had further updates. And we've now taken the opportunity to buy a small allocation in emerging markets. And we funded that by reducing our US exposure from an overweight to neutral. And within the US, we sold down our tech exposure. So we now only have a very small overweight in Fourth Industrial, which is effectively the NASDAQ and the FANG stocks, so down to neutral in the US. And we've nibbled at the emerging markets, still a small allocation in emerging markets, still underweight because there are risks, but things are looking good. So China rallied 30% in September, and then on disappointing news, it pulled back more than half of that by mid-October, and we used that as an opportunity to buy some emerging markets. As you know, we've had no emerging markets in the portfolio for the last year. We've been overweight the US. The US has outperformed emerging markets by 13% over the last year, quite phenomenal outperformance. And so we've banked those gains and made a small nibble into EM, still underweight. So why are we nibbling at emerging markets? Well, number of factors. Primarily, it's the US interest rate cycle. What happens in the US and US interest rates impacts the dollar and impacts the rest of the world. So generally, when the US starts to cut interest rates, as the cost of dollar funding goes down, so that leads to direct profitable impact on emerging market companies, because emerging market companies fund their working capital in dollars. 80% of EM external debt is in dollars. And so as the cost of dollars comes down, so the cost of that funding comes down, and those companies can make larger gains. So it's all about the global interest rate cycle, and that benefits emerging markets generally. Then more specifically, emerging markets have seen inflation fall faster than some developed markets, and EM inflation is now back to pre-COVID levels. Not only that, but monetary policy has been quite tight in emerging markets because they are quite cognizant of what happens to US rates and when the Fed cuts. And so they've been keeping those interest rates quite high. So there's definitely room for emerging market central banks to cut rates as the Fed cuts. Then thirdly, we're starting to see finally, after a long period of negative earnings in emerging markets, the chart on the right there shows in the blue line EM earnings. They've been sitting below zero for quite some time, year on year, and it only just recently popped into positive territory. And according to Alpine Macro, if you use capital good imports as a forward-looking indicator, we could see some strong further increase in emerging market earnings coming forward. And fourth, and finally, and certainly the biggest catalyst and why we've changed our minds is the China stimulus. So China still has a lot of issues, and I don't know if China's done enough to create consumer confidence, but they've definitely done enough to slow down the drag from property, and it will keep their growth on track. And as that growth stops being dragged down by the property sector, so it'll impact all their trade partners and regional partners and neighbors, and that's going to be good for emerging markets. So China stimulus being the big key catalyst that we were looking at, and so we did buy some emerging markets, but we haven't gone even neutral because there are 2 big risks. The one is US presidential elections, and to what extent Trump will put tariffs in, and how the world will retaliate. And then secondly, just how much China's extra support is going to come through. And I think they're still taking quite a cautious view. They've done enough. They've proven that they are serious, but it most likely going to be data dependent on further stimulus coming out of China. So watching those two risks to see when and if we go further into emerging markets.
Tariffs. The overall effect could be massive. I agree it's going to have a massive effect, positive effect.
I don't know what I'm going to do without Trump. From that perspective alone, I hope he wins elections because there's so many great tweets. So it is all about tariffs, and it is strange that South Africa, as a small open economy at the bottom of Africa, while we care so much about what's going to happen in the US, you would think that the US has got such a strong judicial system. It's got Congress, it's got the Senate, and it's got the House. That anything that comes out, any legislation that comes out of that system has to be well thought out and has to be well telegraphed. And effectively, whatever outcomes come through are going to be muted because so many potential parties have to be kept happy. However, when it comes to tariffs, the president has executive powers on any issues that deal with national security. And for some strange reason, it's been approved, and it's completely legal, that tariffs are a way that a president is allowed to deal with national security threats. So all Trump has to do is claim that the rest of the world is a national security threat, and he can put 10% tariffs onto all imports into the US and 60% tariffs onto China and 100% tariffs into Mexico for any Chinese products that are manufactured in Mexico. So it does have a big impact on us because tariffs impacts the rest of the world. But I will talk more about tariffs a bit later. But when it comes to the US, certainly we've seen bond yields rise over the last 2 weeks. We've seen the dollar strengthen over the last 2 weeks, and we've seen US equities go up over the last 2 weeks. And at the same time, Trump's polling has improved. So a lot of people have said, well, it's all about Trump. As Trump wins, Trump's good for US equities. Trump is bad for US bonds. He's good for the dollar. And that's why we're seeing the markets move as they have moved over the last 2 weeks. And possibly so. However, I think there's a greater probability that what we've seen over the last 2 weeks is just more US exceptionalism, more just great data out of the US. And we have seen fantastic data come out of the US. We've seen strong September payrolls, incredibly strong unemployment rate, which ticked back down. So many of you will remember that I mentioned the SARM rule. It was one of the triggers that people were looking at for a recession in the US. Never before in the 70 years that the SARM rule has been in place has it ever been broken. Once the unemployment ticks up by a certain amount, it carries on going up and the US hits recession. Well, it no longer works. For the first time that's been broken, unemployment went up and now unemployment's come back down. And even though the October payrolls were slightly weaker, the unemployment rate was still at 4.1%, below the Fed's target for long-run unemployment. And those October numbers were probably impacted by hurricanes as well. So underlying that, probably very strong employment coming through in the US. Not only that, but very strong retail sales. And then looking at inflation, both the CPI number and the PCE number, the two big inflation numbers that come out of the States, were both higher than expected. And both on the core was higher and the headline was higher. And we also saw super core services rise by the fastest level since April. So what we're seeing in the US right now is the higher for longer playing out, just as we expected. Higher growth, higher inflation, and that's going to keep the Fed from cutting rates too aggressively. And in fact, for the first time now, probably for the last 18 months, we're now seeing the market price in fewer rate cuts than the Fed. So the market's now only pricing in 5 rate cuts, while the Fed is pricing in 6. So that means for the first time in 18 months, the market is no longer pricing in a probability of recession. That's quite a big thing. For a long time, the market's been pricing in a US recession, and because of that, they've been pricing in more rate cuts, and that's one of the reasons we've stayed avoid the US, because we were convinced that we weren't going to see a recession. So that's just another reason that makes us comfortable, not that we want to be out of consensus on purpose, but we have gone neutral the US, even though the data still looks strong, because there is some uncertainty around the US elections. There is a risk that those elections could be contested. But there's also our primary reason is that the AI growth is certainly looking to be fully priced in. There's a lot of great price action coming through in those FANG stocks, the Magnificent Seven, but they have a lot to prove as well when it comes to underlying earnings. And so we're watching that with quite closely. Looking at the charts on the right, just shows that the unemployment rate in the employment market, in terms of monthly additions to the US employment, is sitting very comfortably above its pre-pandemic average. So before COVID, it was adding about 200,000 people to the payrolls every month. And since 2003, that's been averaging 230,000. So again, although the US employment sector has definitely softened, it's softened to more normalized levels and doesn't indicate a recession in the US anytime soon. So the US is looking strong, which is good for stocks. It's not good for bonds. It's good for the dollar. And that's exactly what we've seen over the last 2 months. We've seen strong US markets. We've seen a strong dollar, and we've seen bond yields rise, which has led to bond prices falling in the US. Now, I'll talk again later about Trump, but that is the outlook. If Trump wins, you will see a similar sort of scenario. So it's very understandable how markets have said, well, it's Trump's probability of increasing that's driven that. But I firmly believe that it's the hard data that's come out of the US that is driving that move more than the polls, because really it's so difficult to predict what's going to happen over the next few days in the US and who is going to win. Very, very, very difficult. And the polls have been wrong in the past. So let's move on to China, because that is, I think, from a global growth scenario, far more important than what's happening in the US right now, far more important to South Africa, at least. Here we have the chairman of the National Development and Reform Commission says we're fully confident in achieving the annual economic and social development targets. So what happened in China? We had basically promises that were made in September. The market rallied 30%. And then when it actually came to delivering on some of those fiscal stimulus numbers, people waiting for hard numbers, we didn't get anything. So we had basically every department in China, every department with 3 or 4 letter acronyms coming out to say that yes, we'll protect Chinese growth, and we'll do whatever needs to happen to get growth back on track. But no hard numbers actually came out. So the market then sold off massively, lost more than half of those gains, and we used that as an opportunity to buy emerging markets. Now, China still has serious structural headwinds. So we definitely believe this is a tactical position. From an overall arching perspective, China is still very much focused on common prosperity. And there's definitely a lack of security and protection for private property rights in China. And when it comes to earnings, yes, there are some good movements that are happening from a legislation perspective, but overall, the focus is not on shareholder returns. The focus is on common prosperity. And that's why we think it's probably safer to go via the emerging market route, because while growth will improve in China, it doesn't necessarily mean it will translate into earnings growth in China. But overall, they certainly have done enough. So let's look at some of the things that they've done. Monetary policy. The regulators have cut interest rates far more than was expected. They've cut reserve rate requirements for the banks. They've set up lending facilities to directly support the stock market, and further lending facilities to allow companies to buy share buybacks at very cheap levels. On the housing side, mortgage interest rates have been cut, down payment ratios have been lowered, and Beijing announced, and this is one of the hard numbers that came out mid-October and why we got quite excited, Beijing announced 4 trillion yuan to special loan local government loans to absorb residential inventories and convert them into social housing projects. Basically, local municipalities can now absorb all the extra supply for unfinished houses and convert them into social or low-cost housing and sell them with 100% backing from the national government. So there's no credit losses, there's no risk. They just need to get in and do it. And that's going to make a huge change. It's going to provide liquidity for property developers, and it's going to soak up excess property supply. So that's a big change. And then fiscal stimulus, yes, it's been slow and it's been trickling out, but again, there've been some decent announcements. So a further round of local government debt swap is happening. Basically, the big issue in China has been that the central government relies on the local municipalities to drive growth, but they don't give them all the tax revenue. They give them half the tax revenue, and they rely on local municipalities to fund the other half of that revenue from their own sources, whether it's municipal accounts, but the big source has been local municipalities doing property development. Obviously, that hasn't happened in the last few years. So there's been a shortage of revenue, expenses have stayed high, and municipalities have taken on quite a lot of debt, known as shadow debt, and certainly markets are being quite concerned about the high levels of shadow debt. What's happening now is the central government is taking that shadow debt, putting it into the overall central debt, so it's now a lot more transparent, and they can guarantee that, and it frees up local municipal balance sheets so they can once again get stuck into what they do, which is property development. Not only that, but the central bank is recapitalizing state-owned banks so they can lend, and they also are providing welfare benefits to special groups. So actually, for the first time, China is writing out checks. Yes, it's a very small localized benefit sector they're focusing on, but they are actually writing out checks to provide social benefits to special groups. And then finally, just as the chart on the right shows, the Chinese consumer will respond when there's the right amount of stimulus. So the chart on the right shows overall Chinese retail sales in blue, which are looking not great, but the green dotted line, which has jumped up 20% year on year, is the result of a subsidy program that was put in place where there was cash back for basically cash for clunkers, and you could hand in your toaster or your refrigerator or your TV and get cash for that the central government funded, and use that to buy new appliances. And certainly that has worked. So while there hasn't been a direct, beyond that, there hasn't been direct stimulus to get the Chinese consumer out of its doldrums, I think overall there've been enough measures put in place to prove that Beijing, that Xi Jinping, that China is serious about fixing its growth problem. And while it will take time to fix the housing market, it's certainly not going to be fixed overnight. While it will take time, I think this is they've got to the Draghi moment where he said, we'll do whatever it takes. And that's why we have nibbled in emerging markets, not China directly, but in emerging markets. We will be watching this very closely to see if we need to go into a neutral position on emerging markets. But for now, we are just nibbling, and we'll wait to see exactly what happens in the US elections over the next few days. So it's not just the US and China, but we are still seeing elevated geopolitical risks, both in Russia and Ukraine, and Israel, Gaza, and in the Middle East in general. Here we have Vice President Harris talking harshly to Netanyahu, trying to explain that it's time that the war ends, but it certainly doesn't seem like that war is going to end anytime soon. But despite that, the oil price has pulled back, and that was on the back of weakening China sentiment and certainly de-escalating tensions in the Middle East, when Israel decided or telegraphed that it wasn't going to attack Iran's oil facilities or its nuclear facilities. Tensions in the Middle East remain high, although quite odd. It's a very gentlemanly war, if I can use that term, where Iran and Israel are certainly showing that they will retaliate, but retaliating in such a delicate manner that in order to try and preserve things from escalating or prevent things from escalating. So rather a strange strange way that the war has progressed. That said, there are still risks. So even though it's now more than a year since the Hamas attacked Israel, oil markets remain muted. And one of the reasons for that is that the Straits of Hormuz have not been blocked. I mean, that's a serious choke point through which about a fifth of the daily global oil supplies pass every day. So if Iran was to take things seriously, if they did block that, there could be a major impact on the oil price. Obviously, it would impact them as well. So they're unlikely to do it. I mean, it's not our base case, but definitely the risks remain in that. But if you look at the charts on the right, you can see the green line, which is Brent oil, off its highs as tensions de-escalated, and shipping prices. So this is Shanghai to Rotterdam for the 40-foot containers, also continue to fall despite the fact that those risks remain elevated. So we are keeping a very close eye on both shipping costs and the oil price, but for now, no major signs that we're going to see any supply side disruptions causing inflation down the line to the world. Okay, moving on to South Africa. We had our medium-term budget policy statement, and there was a little bit of slippage in the revenue and expenditure side. So it was rather a disappointing budget. As I said, not as disappointing as the UK, but still certainly a bit worse than everyone was expecting. Here we have our finance minister talking about the 11 billion rand that is being set aside for early retirement for the workforce. Certainly something I'm not, I'm just don't quite understand the logic. I'm sure there is a very good logic to that, but as far as I can see, we have a wage bill problem in that our wage bill is too high and that the increases too fast relative to our expense line. But at the same time, we have too few public servants. We have too few policemen. We have too few nurses. We have too few teachers. So I'm not quite sure how when you have expenses that are too high and not enough people, how spending more money to reduce the number of people we have fixes the problem. But anyway, that's not for me to understand. That's for our clever people at Treasury. But what I can say is the market was disappointed by the budget. As bond yields rose and the rand weakened as the unexpected fiscal slippage disappointed the markets. You know, it is quite scary to see how much debt South Africa has taken on so quickly. So when you look back to when South Africa was investment grade, when we were downgraded to junk at that time, so when we were actually downgraded to junk at that time, the credit rating agencies forecast a peak debt to GDP of 52.9% in South Africa. We're now sitting at looking at a best case scenario peak of 75.5%. It was 75.3. The slippage in the budget has pushed it up to 75.5. Also seeing the budget gap rising from 4.5% to 5%. So basically taking on more debt. And not only is that debt peaking at a high level, but if you look at the years past that, yes, there is consolidation in the debt numbers. The debt numbers do come down, but they come down far more slowly than previously. So for one side, you might say, well, that's great. You know, our growth is slow. We do need to have a pro-cyclical budget which stimulates growth by spending. I understand that. But at the same time, we do need to be cognizant of how much debt we have taken on over the past few years. Not only that, but there's massive risk that those debt levels could balloon because there are a lot of spending risks that haven't been included in the budget. There's a risk that we have to bail out more SOEs. Transnet's looking top of the list right now. There's a risk that we have to bail out municipalities. There's a risk that the road accident fund might have to be bailed out. And that's sitting with over 400 billion rand in liabilities. So lots of risk to the spending side. And I think that we remain neutral on South African bonds. I do think that there are risks. And the chart on the right, I think, is a fascinating chart. Now, this is from Nedbank. They looked at what has been driving South African bond yields over the 2023 period. So if you look at the chart, you've got different parts of the yield curve. You've got the first vertical bar is the 2-year bond yield, then the 5-year, then the 10-year, and then the 30-year bond yield. And as can be expected, the short end of the yield curve, the 2 years, is very much driven by the pink, which is the repo rate, our interest rates, whether we raise rates or cut rates. That impacts the very short end of the curve. But it's also equally driven by US short rates. And what that talks to is just the fact that the world is now synchronized to the US interest rate cycle. So back in the 1990s, most emerging markets had pegged their currency to the dollar. Since then, emerging markets have allowed their currencies to float, but to avoid massive weakening or strengthening of their currencies, they have to keep the interest rate differential relatively in line with the Fed, which means when the Fed cuts, South Africa has to cut, and when the Fed hikes, South Africa has to cut. And this chart proves that our short end bond yield curve is driven equally by what we do and by what the US does, because we're all synchronized globally. But it's the green bars that are fascinating, and that shows our debt to GDP, which effectively is one of the measures that the credit rating agencies use to measure our credit rating. The higher our debt to GDP, the lower the credit rating. And you can see there, the further out you move in our yield curve, the more focus is placed on our credit rating, on our debt to GDP, whether we are going to default, and less on what our short rates do. Basically, it means that our yield curve becomes very steep the higher our debt to GDP levels go. And that then prices out equities, because foreigners, when they're looking at equities, they use our long-term bond yields to discount South African corporate earnings, because that's the risk-free rate. Or if you're looking for infrastructure debt, it's again benchmarked against government debt, because that's your risk-free rate. So the higher our debt to GDP levels, the higher our long-term bond yields, and the more the government crowds out the private sector. So that's definitely something that we need to worry about. And the fact that we are seeing such slow consolidation in our debt to GDP levels is a concern. And the fact there are spending risks is a concern. Now, I'm not the only one who's saying this. The IMF came out to say that South Africa needs to do a lot more in terms of fiscal consolidation, and they would like to see a debt ceiling. Now, despite the IMF coming out to say they want to see a debt ceiling, nothing was announced at our medium-term budget policy statements. There's no debt ceiling. There's in fact, what they did say is that in March next year, a discussion document will begin on whether some sort of fiscal anchor is appropriate for South Africa. Certainly, I believe that is very important for this exact reason, that if we don't want government debt to crowd out private sector investment in infrastructure, private sector investment into equities, we need to get our debt to GDP levels back down to investment grade levels. Yes, it has to be balanced by not being too conservative, and yes, we need to grow, and ideally the best way forward is to grow your way out of debt. So you do have a stimulative budget, which is what we've had, and if we can get growth up, well, then you can grow your way out of debt quite nicely, and that's certainly the best case scenario, but we need to get that growth. And for right now, we're not seeing the growth coming through yet. We certainly need more reforms. And we need to get more private-public partnerships. But definitely that was one of the upsides to the budget, was National Treasury's got a very strong focus on getting more private-public partnerships in place, facilitating them, making sure they happen. Certainly, as custodians of retirement assets, we are very, very eager to invest in public-private partnerships. We want to get those good yields for our clients. We want to support the growth of South Africa. It's just, lots of bureaucracy is holding up that process. So let's hope we see some progress there. But when it comes down to it, unfortunately, it really is at the moment about hope. A lot of conferences are seeing renewed interest by foreign investors. So we had the RMB conference, you've had other conferences where we're seeing a lot more foreigners arriving. but none of them are prepared to buy just yet. They're all saying things are looking exciting, there's a lot of potential, but it's a wait and see approach. And I think that's what everyone is doing. You know, everyone got burnt by Ramaphosa in 2017 when there were promises made, and equity markets responded, bond markets responded, the rand responded, and those promises of reforms didn't turn out to happen. So yeah, we remain cautious, like the market seems to be. It's not just us. Alpine Macro closed their overweight rand dollar position, but that was equally due to the fact that they see a strong dollar because of the strong data coming out of the US. So whether it's looking at the strong dollar or worrying about Trump risks and tariffs, we are comfortable maintaining our neutral position in South African assets. So we'll wait and see. So looking at the outlook, we had the chief economist of the IMF talking about the outlook. And as economists love to do, there's lots of hand waving and two sides to every equation. Nothing can be guaranteed. It's all ceteris paribus. And here we've got the chief economist of the IMF saying that the risks are building up to the downside, that there is growing uncertainty in the global economy. So a lot of double negatives and confusing statements, but they did downgrade 2025's global growth by 0.1%. So not a huge change. 2024 stayed the same, 2025 down by 0.1%. And the chart on the right just shows there the changes relative to the prior forecasts. The big changes happening next year. On the upside, the US was upgraded by 0.3%. South Africa also upgraded by 0.3%, so that's fantastic. Despite them being very cautious about our lack of fiscal consolidation, they did upgrade our growth by 0.3%, but to a paltry 1.5%. That's hardly anything to get excited about. And then on the downgrade side, Mexico being downgraded by 0.3%. Certainly since their elections, things have turned for the worse, and there have been some major outflows out of Mexico, and it's unwound quite a large portion of its premium. And then Germany down 0.5%. Germany really struggling at the moment. Things looking quite tough there, particularly driven by their loss of manufacturing market share to China. So things looking tough in the manufacturing hub of Europe, with Germany being downgraded. Now, some of the risks that the IMF spoke about was firstly trade protection wars. They're very concerned about what Trump is going to do and the tariffs. And they're also concerned about public debt, which they expect to reach $100 trillion, or 93% of world GDP by the end of the year, primarily driven by the US and China. And those are scary levels. When you get to anything over 80%, growth certainly slows down. And at some point, we have to stop kicking the can down the road and stop driving everything by growth, by debt. But for now, we don't do that. Real time, as I said, things are looking good. We are starting to see some good data coming out of China. The US certainly looking very strong. JP Morgan's global GDP real-time forecast has been raised to 2.8%. That's for the current quarter. That's 0.5% above potential growth. It's a 0.7% upgrade. And that's one of the reasons that keeps us bullish equities, because as long as growth is being upgraded by the two major economies in the world, we're unlikely to see a recession in the short term. Of course, as I said, risks do remain. We've got Middle East, we've got Russia, Ukraine, and we've got the US elections. So let's talk about the US elections. I'm sure you're all waiting to hear what that means for portfolios and what that means for you. So despite a lot of noise, if you look at the economic policies of both parties, the Democrats and the Republicans, they actually are quite similar. Certainly, there's a lot of overlap about the major policies. Both are anti-China. Both are pro-tax cuts. And despite very high debt levels, and again, here we've got the IMF warning of US debt to GDP, which is going to be 100% of GDP by the end of this year, both parties want to increase spending. And that's good for growth in the US because of that fiscal spend, and that's good for US equities. and it's good for the dollar. So both parties very much focused on US exceptionalism and driving a stronger US. So what are the various outcomes? Well, the one outcome is you get a split Congress. Now, if there's a split Congress, it means that we're likely to see fewer policy changes, less tax cuts, less fiscal stimulus, less US exceptionalism. We might even see some of those tax cut expire, which should be bad for the US. So certainly a split Congress means less upside to the US. And I think a blue sweep with Harris has a very similar outlook to a split Congress. Now, under a Trump presidency, as I've said, Trump has those executive powers to combat national security threats. And certainly under a Trump presidency, whether it's a split Congress or a red sweep, you will see higher tariffs, and that's going to weigh on non-US growth. So IMF forecasts minus 0.7% GDP relative move. So whatever their forecasts are for non-US GDP growth in the rest of the world, they're going to downgrade that by 0.7% if Trump becomes president because of the negative impact of tariffs. So certainly if Trump is president, it's bad for Europe, it's bad for Japan, it's bad for China in particular, which is bad for commodities, which is bad for South Africa, bad for emerging markets. So the worst thing that can happen for the rest of the world is a Trump presidency. The best thing that can happen for the US is a red sweep, because there not only does Trump enact his tariffs, but he'll be able to do further tax cuts, more fiscal support, and that'll drive US growth, US equities, and the dollar. So roughly speaking, if Trump wins and it's a split Congress, I think markets are pricing in a lot of that. If Trump wins and it's a red sweep, Republicans get the Senate and the House, or then we could see bond yields in the US going higher. We could see US equities going higher. We could see the dollar going stronger as all of that happens. At the same time, we could see a sell-off in Europe and Japan and emerging markets. If Trump is president, but it's a split Congress, well, then it's less good for the US. And then we're still going to see the negative impact on the rest of the world through tariffs, but unlikely to see as much positive stimulus coming through from on the US. So neutral US, but negative on the rest of the world. And whether Harris wins or whether it's a blue sweep or a split Congress, then we're probably going to see the dollar weaken slightly, bond yields come off in the US because there'll be less fiscal support, less inflation, dollar weakness. It's good for US bonds, bad for US equities, and good for the rest of the world. So if you invested only in the US, you want Trump to win with a red sweep. If you invested anywhere else in the world, you really are hoping for a split Congress and possibly a Harris victory with less tariffs. So it is important. However, it's also important to remember what happened in the first term. So in Trump's first term, he enacted a lot of tariffs. Now, the IMF and certainly economic theory would say that because of those tariffs, we should have seen a stronger dollar. We should have seen bond yields go up. We should have seen manufacturing growth being supported in the US as a result of those tariffs because they become more competitive. We saw none of that. The dollar actually weakened, manufacturing employment went down, and there was deflation in the US. So it doesn't necessarily mean that what economic theory predicts is going to happen. Not only that, but during Trump's first term, Chinese equities rallied incredibly well. It was only when Xi Jinping started to talk about common prosperity and China's own goals, which catalyzed the property bust, that China shrank. So yes, everyone's predicting that should Trump win and should there be tariffs, that the dollar is going to strengthen and bond yields going to go up and employment's going to do well in the US and China's going to struggle. But in Trump's first term, none of that happened. So possibly Trump has learned from his first term and he will change policy to make sure it happens. Or maybe there's so many moving parts in the world and the way the rest of the world reacts prevents it from happening, it's very difficult to say. I still think the major force that's, while it's a risk, I mean, definitely I think that we'll see some knee-jerk reactions over the next few days. I think the major force that's going to be driving the markets is US exceptionalism, how long the US stays so strong, and China, how quickly they stimulate the economy and how quickly that drives the global manufacturing cycle, and as a result drives emerging markets and Japan and Europe and the rest of that cycle. So while it's very important to watch what's going to happen, and it's certainly fascinating, it's less certain what those impacts will be based on Trump's first term. So fascinating times, always exciting. I'm going to hand over to Anrich, who'll take us through the Income Maximiser portfolio before I come back and take your questions.
Good morning, everyone. So today I'm just going to provide an update on our Sygnia Life Income Maximiser Fund. So if we take a look at the spectrum of fixed income products that we manage at Sygnia, we've got across the whole fixed income spectrum. So starting with the lowest risk, stock standard money market fund, very short dated, very low credit risk. Then we have our enhanced income unit trust. So there we can add a bit more credit spread. We can add, some term premium. Importantly, the fund is managed with a focus on not taking on a lot of interest rate risk, so not a lot of duration. And then at the top, we have our All-B tracker and our enhanced all bond fund, where we aim to outperform the index by enhancing that yield while not taking on any additional interest rate risk. And then slap bang in the middle, we have the Sygnia Income Maximiser Fund. So this fund it's still an income fund, but it's less constrained in terms of duration risk and the asset classes that we can allocate to. So we'll take a look at that in more detail. These are some of the current stats for the fund. So it's yielding 10.4% on a gross basis. Importantly, we've been able to keep it at this level or even higher, regardless of where the yield curve is. And it currently has a weighted average duration of just under 3 years. If you compare that with the All-B as at the end of September, that had a yield of around 9.5%, and it had 6 years duration. So we are improving on the yield and at half of the interest rate risk. And then because we do have a nominal bond allocation, the weighted average maturity is just over 6 years, but our credit allocation in the fund is mostly shorter than 5 years. So the fund is very much designed for, with living annuities in mind. It's constructed to provide, a very high income stream for clients who don't need to draw down on capital, daily or monthly or very often. So clients who can stomach a bit more volatility over the short term. And we do this by switching between different fixed income asset classes, depending on what is providing the most value. So those are some of the options that we've had in the fund or that currently have. And on the right-hand side, it's just an overview of some of the relevant yields for what we hold in the fund. We currently do not hold any property shares. We held some at the start of the fund. And even though those companies, I think the index is up almost 50% over 12 months, most of that is price returns. It's come from a re-rating in the valuation of those assets. So it's not really providing a strong dividend yield. Then the darker purple line or blue line is the All-B yield, and you can see how after the election those yields have come in. We've seen a big rally in nominal bonds, and then contrasted against that is the light purple line, which represents the yield we can get on our credit allocation. So using 3-month JIBOR plus 200 basis points as a proxy for that allocation. And at the moment, you can see how attractive that yield is compared to bonds, especially on a risk-adjusted basis. Then at the top, Yeah, so we had an interesting opportunity during COVID. Bank NCDs or certificates of deposit. It's essentially a tradable deposit. So you go to a bank, you give them a maturity date, they quote your rate, and you can sell that deposit back at any time. And as the market prices in, kind of excessive expectations of future rate hikes, the swap curve moves up at the longer end. So we were able to get some very attractive yields on those 5-year certificates of deposit. Now, because we traded them at those peaks, you can see at the top, and normally they pay semi-annual coupons, it would have been very difficult to reinvest, each coupon for 5 years at those very high rates. So we decided to roll up the coupon and trade them as zero instruments. And that's the yield you see there at the top. Then if we break the fund down into 4 broad strategies, you can see the yield for each component and also the duration risk involved. We only very recently added inflation-linked bonds. It was a very specific opportunity. Those long-end break-even yields came down quite a bit, which just means it's cheap to buy that inflation protection. So that's your yield on a nominal basis. On a real yield basis, it's closer to 5.5% after inflation. And then we spoke about how we switch between asset classes depending on the steepness of the yield curve. So that graph at the bottom is to illustrate how that works. The lighter line is essentially the difference in yield between a very long-dated government bond and a very short-dated one. So you can see pre-COVID, for the longest time, you barely got 1% extra for going out that far in the yield curve. Just before 2020, you could get up to 1.5%. And then as COVID happened and fiscal risks increased, you can see how that steepness increased. So the difference between a bond maturing in 2048 and a bond maturing in 2026 was almost 5%. And if that's the case, you are actually being compensated for taking on that extra interest rate risk. And the same goes for the swap curve, which is why we were able to get those attractive certificates of deposit. Now, as we are able to switch between these asset classes, you can see how our allocations in the fund have changed over time. We had some property stocks at the very start, although nothing recently. And then you can see how those allocations changed depending on the yield curve, depending on floating rates. Our nominal bond exposure has been quite high because this fund was launched in 2021. So obviously the nominal yield curve very elevated since then. And then towards the end of September, we actually traded that allocation down to below 30%. Then if we take a look at a more granular level, if you drill through all the components, all the underlying funds, this is your exposure to the different sectors and the top 10 biggest issuers. You can see just below 80% of the fund is exposed to a combination of the government and the big 5 banks. So, very low credit risk in that regard. And in our credit allocation in the fund, we actually have exposure to more than 60 unique issuers to diversify that credit risk. This is what the fund looked like as at the end of September. As I mentioned, we added inflation-linked bonds for the first time. We reduced our nominal bond exposure and allocated that to floating rate notes, which is our credit allocation. And you can see from this, you have exposure to cash rates, to the JIBAR curve, the nominal yield curve, the real yield curve, the swap curve. So an excellent level of diversification in the fund. And then this is what it all comes down to. So your gross performance. As I said, this is for investors who don't need to draw down on capital over the very short term very often. So you can stomach a bit more of that volatility from the duration risk. And you can see how well the fund has done. So obviously over 12 months with the rally in the yield curve, very strong performance, just under 22%. But focusing on the longer term, if you look at 3 years, still 3.5% ahead of cash. If you look at the since inception number, which I haven't included here, but that's closer to 4% on a gross basis. So even over the longer term, very strong performance. And I think this graph just summarizes the concept of the fund very well. Even though we had that nice bump in price returns over the last year, the focus is very much on producing consistent and strong income stream, which you can see there. That's the bar at the bottom. And then over the longer term, those returns from the price returns or the capital impact will play a smaller part, and it really comes down to income generation. Thank you very much.
Thanks, Anrich. Okay, let's have a look at the Q&A. Andrew asks if this session is recorded. Yes, Andrew, all our webinars are recorded and are available on the Sygnia YouTube channel. So just Google that, Sygnia YouTube channel, and you can find a copy of this and all our webinars. Landa asks, how does SA property fit into the graph? I presume you're talking about the month of October. Property did struggle a bit in the month of October, but still one-year numbers on property are phenomenal. As you saw in Anrich's chart, very interesting how those yields out of property stocks are basically halved from 10% down to 5%. As the price has recovered. So I think a lot of good news now priced back into property. For a long time, property had structural headwinds and was very, very cheap. So you have to balance those two things. Now it's a little bit easier, I think, because the property still faces structural headwinds and it's no longer looking that cheap. So yeah, we don't have any property in our income portfolios. Christopher says, Prof. Alan Lichtman has predicted every White House victory except for one, and he is predicting a Harris victory. So that we'll see how that rolls out. I've also seen some interesting stats on the 3-month S&P 500 performance, and when the 3-month performance is up, the incumbent stays in, and when the 3-month performance is down, the incumbent is replaced. And that's also worked out with very high probability levels, but we'll see. We'll see. Certainly, it's going to be very interesting to watch what unfolds. Leon says, is there anything that South Africa can learn from China on how to protect and stimulate the economy? Leon, I think what's vital for our economy is the private-public partnerships, and certainly National Treasury is working very hard to make sure that there are sufficient mechanisms in place for the private sector to support the public sector, and I think that is our key to moving forward. Certainly, there's not enough money to do anything without the private sector, and if the private sector is in there to help provide expertise and to ensure things are kept on track, well, then we get some proper delivery for that spend. That's going to be very good for our infrastructure. And once we have solid infrastructure and people stop worrying about water and ports and rails, well, then we can move forward. Already there's an improved sentiment in South Africa because we've now day 222, I think, of no load shedding. And that has improved sentiment in South Africa, but we still have a few other infrastructural headwinds to get through. But we are starting to see things being put in place so that can be fixed. So we're watching that, and hopefully those mechanisms are put in place, and hopefully those partnerships do take place, and we start to see some improvement in our rail and port and water infrastructure. Christopher says that the 1930s depression was exacerbated by tariff increases. Christopher, you're spot on. Any economic model will tell you that tariffs are bad for growth, not just for the rest of the world, but actually bad for US growth. Tariffs don't properly allocate capital to where capital is supposed to be. That leads to inefficient allocation of capital, which leads to growth decreases. So it wasn't that clear what happened, if that happened in Trump's first term. Certainly didn't help employment, which was the main aim of those tariffs. So we'll see what happens, but certainly tariffs are not good for growth. That's why it needs to be balanced with tax cuts, which Trump wants to put through, and more fiscal support, which will then counter the negative impacts of tariffs. So again, under a red sweep, Trump will have tariffs and tax cuts and fiscal support, which will counter the negative drag from any potential negative drag from tariffs. Under a split Congress with Trump as president, you're going to have tariffs, but Trump's not going to be able to keep the tax rates as low as they are, and he's not going to be able to do the same fiscal spend because of the split Congress and the gridlock that happens. And so you might actually see the growth not improving under that scenario. So that's why it's the best case for equities is a red sweep. Gridlock is mixed, as is a Harris victory. Bradley asks, why is Warren Buffett holding so much cash? Certainly, those cash reserves are at an all-time high. I think nearly close to 30% of Berkshire Hathaway's market cap is cash. I can only assume it's based on valuations. The US stock market in particular is looking incredibly expensive. We did have Goldman Sachs come out to say that over the next decade, they expect only a 3% return from global equities per year, which compared to the outlook for global US bonds, which is about 4.5%, or you'd rather have bonds than equities based on that outlook. So Buffett might be taking a valuation look through. Certainly, given the size of his portfolio, it's not something that he can wait. He can't wait for a recession to happen and then make that move. So I think he might just be accumulating cash, banking gains into a potential slowdown within the next year or two. But we'll have to see exactly where he's going to allocate that cash. Andre asks, is it a good time to buy a general India ETF? Andre, India is looking good. Certainly, they've had fantastic earnings growth over the last 5 years. The outlook has dimmed somewhat since the election results, and Modi lost his all-out majority. So that is going to slow down reforms going forward. And India is on a very high PE. From a valuation perspective, India is the same PE as the US. So whether I'd pay the same amount for India as I would for the US, I wouldn't. But it certainly is one of the cleanest emerging market regions at the moment, but it's expensive as a result. Andre says, what is the difference between the S&P 500 net total return index and the S&P 500 index? So the S&P 500 net total return index is net of dividend withholding tax. I think it's the main difference there. So there are slight differences from an expense perspective. We do claim back a lot of our dividends, but there is certain withholding tax, and we can only claim back a certain amount for those indices. But one of the reasons that we do invest our ETFs directly, we hold Apple, we don't hold a US ETF as a feeder fund, is to maximize those dividend reclaims that we can make. Peter says it's a pity that our China ETF is now a boring China ETF. Certainly, as part of the move we switched our China ETF from investing directly to becoming a feeder fund. That unfortunately was to keep the costs down. Because the fund was quite small, because no one was interested in China, because performance had fallen so dramatically, buying stocks directly was just too expensive. We didn't want a high TER. We didn't want those trading costs to impact performance. So we had to switch that fund to a feeder fund. But guaranteed, once that fund gets above a certain size, we will switch back to investing in direct Chinese equities. We are only one of 2 asset managers in South Africa that are allowed to buy onshore Chinese shares. So we do have that facility, and we will use it when it makes sense. Unfortunately, it only makes sense when we're above a certain AUM threshold to keep our TERs low on those ETFs. So as always, with all our ETFs, we do our absolute best to keep the spreads low, keep the TERs low, to maximize the net return, keep the tax rates low with dividend withholding tax, to maximize those returns to you as investors. And that is it from the Q&A perspective. No more. Oh, sorry, one more question has just snuck in. Paul says, why is the FTSE 100 performance so pedestrian? Paul, it's a good question. So the FTSE 100 has about probably the smallest allocation to technology out of the major global economies. It's got the highest allocation to oil. Oil hasn't done very well. As you know, the oil price has moved sideways. Technology has done incredibly well. So most of the lagging in the FTSE 100 performance is a result of its underlying composition, with low allocation to technology, high allocation to oil. But in general, the US has outperformed Europe, the UK, Japan. It hasn't been too much performance differential between the UK and other non-US ETFs over the medium term. Okay, that is it for today. Thank you, everybody, for joining. It was great to be with you. Please join us for the December webinar. It is the final webinar for the year, and we will be doing a poll on the outlook for the assets for 2025. We've certainly got our views of what is the best asset class and best theme and best sector for next year, which we will share with you. But I would love to hear your views, and we'll do that in a poll next month. Have a great November. Good luck with the US elections. Hope it goes your way, and I will see you next month. Cheers.